the day Europe stopped banking alone. They believed borders could protect money. They believed risk stopped at the edge of a nation. They were wrong. To understand modern European banking, we need to return to a quieter moment, a time before crisis headlines, before emergency summits, before the word contagion entered everyday language, because the foundations of today's financial system were laid long before everything began to shake. For decades, European banks were built to serve national economies. French banks financed French industry. German banks supported German exporters. Italian banks stayed close to Italian households. Each system followed its own rules, traditions, and political logic. Stability came from familiarity, and distance felt like safety. But Europe was changing faster than its banks realized. The creation of the single market removed barriers not only for goods and people, but for capital. Money was suddenly free to move across borders at unprecedented speed. Interest rates converged, currencies aligned, and banks discovered an opportunity too large to ignore. At first, it looked like progress. Expanding abroad meant diversification. Lending beyond national borders promised higher returns with lower risk. If one economy slowed, another could compensate. On paper, it was a perfect hedge. European banks began buying foreign institutions, opening branches, and lending aggressively across borders. Balance sheets grew, profits followed, and confidence surged. The system appeared stronger because it was bigger, but beneath the surface, something subtle was happening. Risk was no longer contained within national boundaries. A loan issued in one country was now funded by deposits from another. Losses in one market quietly migrated through interbank channels into others. What had once been separate systems were slowly merging into a single, invisible network. Few noticed the shift. Fewer questioned it. Regulators still thought in national terms. Supervision remained fragmented. Responsibility stopped at the border, even as money ignored it completely. Each authority assumed someone else was watching the bigger picture. And then came the first signs of strain. Small disruptions rippled farther than expected. Liquidity tightened in places that seemed unrelated. Trust between institutions began to depend less on nationality and more on exposure. Banks no longer asked where their counterparties were based. They asked who they were connected to. Europe had stopped banking alone, not through a single decision, but through thousands of quiet choices, each one logical, each one profitable, each one bringing the system closer together, while making it harder to control. And when pressure finally arrived, it would not respect borders either. What made the system powerful also made it fragile. As banks expanded across Europe, they became increasingly dependent on each other. Short-term funding replaced long-term caution. Interbank lending became the engine that kept everything moving. Every night, billions flowed quietly between institutions, balancing books, smoothing risks, and creating the illusion of constant stability. Trust was the currency that mattered most. As long as banks believed others were sound, the system worked. Liquidity moved freely. Credit stayed cheap. Growth looked effortless. Few paused to ask what would happen if that trust ever weakened, because no one was prepared for how quickly confidence could disappear. The structure of European banking had changed, but oversight had not followed. Supervision remained national. Rules differed from country to country. Capital requirements varied. Risk models were approved locally, even when exposure was international. Each regulator saw only a fragment of the whole. Banks learned how to operate inside these gaps. They shifted assets across borders to reduce capital charges. They booked profits in one jurisdiction while parking risk in another. Complexity was no longer a side effect. It became a strategy. Balance sheets grew opaque, even to those managing them. Meanwhile, governments still believed their banks were national champions. They assumed responsibility ended at home, that a crisis inside one country could be managed with domestic tools. What they missed was how deeply intertwined their institutions had become. By the time problems surfaced, ownership and exposure were already scattered across Europe. The warning signs were there. Funding markets began to favor certain banks over others. Small differences in perceived risk led to widening spreads. Some institutions found it harder to borrow overnight. Others demanded more collateral. These were quiet signals, easy to dismiss during good times. But stress does not announce itself loudly at first. It moves through hesitation, through unanswered calls, through transactions that take a little longer to clear. And in a system built on speed and confidence, even small delays matter. Banks responded by pulling back. They reduced lending. They hoarded liquidity. They trusted fewer counterparties. What had once been an integrated network started to fragment under pressure. The same connections that once spread opportunity now spread fear. And still, no single authority had the mandate to intervene decisively. Each country waited. Each regulator monitored its own institutions. Each assumed the shock would remain contained. But the system no longer worked that way. Europe had built a shared banking reality without shared control. And the moment that reality was tested, the consequences would move faster than anyone expected. When the pressure intensified, the illusion finally broke. What began as isolated funding stress quickly turned systemic. Banks no longer trusted balance sheets. They questioned guarantees. They doubted collateral that once seemed unquestionable. The interbank market, the system's invisible bloodstream, began to freeze. And when it froze, everything slowed. Institutions that depended on overnight funding suddenly faced existential risk. Without daily liquidity, even healthy banks could fail. Survival no longer depended on long-term solvency, but on access to cash before morning. Governments were caught off guard. They had built crisis tools for national problems. But now, losses spread across borders faster than political decisions could follow. A bank headquartered in one country could destabilize markets in several others within hours. Responsibility became blurred. Authority became fragmented. Who was supposed to act? National governments hesitated to rescue institutions with foreign exposure. Taxpayers questioned why domestic money should support international risk. Meanwhile, failure was no longer an option. Letting a major bank collapse threatened to pull others down with it. Every choice carried consequences. Interventions meant breaking long-held principles. Non-intervention meant risking collapse. Leaders face a paradox with no clean solution. Protect the system or protect sovereignty. Markets sensed the hesitation. Bond yield spiked. Bank shares collapsed. Rumors replaced data. Fear moved faster than facts. What had once been technical problems became political emergencies overnight. Banks responded defensively. They cut cross-border lending. They withdrew from foreign markets. Capital retreated behind national lines, reversing years of integration in weeks. The same connections that once unified Europe now amplified division. This was the cost of partial integration. A shared market without shared supervision. Shared risk without shared accountability. Europe had built a banking system that operated as one, but governed as many. And under stress, that contradiction became impossible to ignore. The crisis was no longer about individual banks. It was about the structure itself, about a system designed for efficiency, but untested under pressure, about the assumption that trust would always be there. That assumption was gone. What remained was a choice Europe could no longer delay: adapt the system to match reality, or watch it fracture under its own weight. And the next move would define the future of European banking. The breaking point forced clarity. Europe could no longer pretend its banks were purely national. The crisis had revealed a simple truth. Money moved as one system, but responsibility did not. And that mismatch had turned financial stress into political danger. The response was swift but uneasy. Emergency liquidity flooded markets. Governments stepped in as lenders of last resort. Rules were bent. Red lines were crossed. Not because leaders wanted to, but because the alternative was collapse. Stability became the priority, even at the cost of precedent. Yet the deeper lesson went beyond rescue. Europe began to understand that integration without coordination was unsustainable. A shared banking reality required shared oversight. Shared risk demanded shared rules. What had once seemed like technical detail became a question of survival. This realization reshaped everything. Supervision slowly moved beyond national boundaries. Stress tests became continental. Capital standards tightened. Transparency was no longer optional. The goal was no longer growth at any cost, but resilience under pressure. Still, the system did not reset overnight. Trust, once broken, takes time to rebuild. Banks remained cautious. Cross-border lending recovered slowly. Markets learned to price fragmentation, not just fundamentals. The memory of sudden freezes lingered in every transaction. And yet, something had changed for good. Europe had seen what happened when invisible connections were ignored, when responsibility lagged behind reality, when confidence was assumed instead of secured. The cost of that lesson was enormous, but it was no longer abstract. Today's European banking system carries that history quietly. Every rule, every buffer, every shared institution reflects the moment borders stop protecting money. The system is stronger, but also more aware of its limits, because the same forces that once fueled growth can still amplify risk. What matters now is vigilance, not just from regulators or governments, but from anyone who believes stability is automatic, because banking does not fail loudly at first. It fails quietly, through trust, through hesitation, through connections no one is watching closely enough. And Europe learned that lesson the hard way. Subscribe to join the journey. The day